One of the key things in business is understanding economics, and one key element of economics is understanding assets. Assets versus liabilities. And a lot of you already have come across this term and may already know this, but it's worthwhile recapping the difference between assets and liabilities, because if we forget this, sometimes fear could creep in later that could jeopardize you from doing deals. But conversely, you may actually do a deal which turns out to be a liability. So let's dig in. And before we dig in, I'd like to pose this question. If I were to give you £1 million of debt, how would you feel about that? Now, let me rephrase that. I've given you £1 million to spend, which means that you're in £1 million pounds of debt to myself. Would this worry you? For a lot of people, this would worry them because the fear kicks in, and the fear should not kick in because it's something it's out of people's comfort zone. But hopefully, you will have the opportunity where people will offer you tens of thousands of pounds, perhaps £100,000, or maybe in the future, they may offer you millions of pounds. Hopefully, the fear will not set in because it's just numbers, extra zeros. So, assets versus liabilities. What is the difference? Assets help put money into your pocket every single month. Can you think of any types of assets? Maybe things like equipment or property, or maybe stocks or shares, dividends, royalties from books and music. There are artists who sell their music, there's authors that sell their books, there's people who rent their equipment. But what do they have in common? Is that the owners have acquired this asset with and make money on a monthly basis without much time invested. So with little or no time involved. Liabilities, on the other hand, remove money from your pocket. So can you think of any liabilities? What things take money from your pocket every single month? Now you may be thinking mortgages, loans, employees, etc., cars, equipment, even your home. How can that be? Because, for example, cars, it costs you money every month. It could be your MOT, tax, road insurance, fuel, maintenance, etc., etc. Cars, on the other hand, could be assets because you could rent out your car, and there are companies out there to do that. So there are those companies who make money from cars. But what about your home? People believe their house is an asset, and your financial planner, maybe your real estate agent, maybe your accountant, all call your house, your property, an asset. But that's completely false. Based on these statements in front of you, it's a liability. Your house, your home, your property removes money from your pocket every single month. And when things are bleeding you money, then it is a problem that you need to fix. And there's different ways of doing that. This could be to spend some money on the asset, to rent it out, or simply to get rid of it to minimize damage limitation. It does not matter if you have one property or 100 properties. Although overall a balance it may be positive cash flow, you still need to address problem properties. Owning a lot of expensive properties may not actually be a good thing. We have some friends in the city, in this case, for example, London, who own London properties. But with changes in the law and the taxes, they are now actually losing money every month. Those assets have now turned into liabilities. So it's very important to keep up with regulations because regulations can impact your profits and your business. So, let's assume that £1 million has been given to you, which means that you're in £1 million of debt to that lender. And you need to pay it back at some point. How would you feel? Now, let's say, for example, we take the scenario whereby we buy the £1 million of debt and we invest it in, say, not one property, but multiple properties. What's that give to you? What situation are you in? You get positive capital growth from the property. Yes, history cannot predict the future, but if we look back on history, we can see that property prices have been going up. And why is that? It's simply down to economics, supply and demand. We have a growing population, which means that the actual demand is far outstripping the supply of properties being built, and that means property prices goes up. Now there's different ways to use that money. We could have an interest-only mortgage, whereby at the end of the term, which could be 20, 30, or maybe longer, many years, that you have to pay back the original capital because you've only been paying off the interest rate. But also remember that you get cash flow, you got rent every single month. And with the cash flow, you can actually use that to pay down the debt, the capital repayment back. And this allows you to do many things in property. For example, buying multiple properties and maybe in the future selling 1, 2, 3 or a portion of those houses because the prices have gone up, but the debts are either the same or have gone down across your portfolio. So if, going back to this scenario, if you borrowed £1 million, then it should be a no-brainer. And this is one of the first strategies you need to learn as an investor is a no money left in or no money down deal. All the money is provided by your financial partner, say for example 1 million, and you'd invested it. And then you're just getting the cash flow, the capital, and over time you pay them back. And you can get houses for free. Using yield. Now, as entrepreneurs, you tend to use several key indicators, and especially property has things like yield. Now, yield is commonly used by estate agents, and you can quickly go into property places, property portals like Rightmove and Zoopla, etc., and you can find from time to time adverts mentioning the yield, etc. But this is a common mistake by estate agents. You need to remember that the majority of people working in an estate agent do not actually invest in property themselves. They are just salespeople. Sometimes they're fresh-faced youths getting in on their career early, or maybe conversely, they stay there for a very, very long time, working 9 to 5, and all they understand and all they know is the term yield, because the term yield is what they get to present to their vanilla investors. And you are not a vanilla investor. As entrepreneurs, this is the wrong way to think about things. So how do we calculate the right way? Before we calculate the right way, we need to understand why is this wrong. We need to calculate the yield. So how do we calculate the yield? The yield is the annual rent, and not just the annual rent, it's the gross rent. And that means with gross is that it doesn't take into consideration of any costs. It's just how much rent you're covering every single month, and that's that. So in the annual gross rent, with no consideration of costs and maintenance and boiler breakdowns, etc., you get the annual monetary value divided by the purchase price and times by 100 to give you the actual yield. Now, the truth with this is that it does not take into consideration the actual profit that you take home, because it doesn't take into consideration the costs involved for having this asset. Or actually, it does not even consider the actual money into the deal into the first place. Of course, the money you put in, the more money you put in, the less mortgage debt per month you have. And with the less mortgage debt per month, you're able to take more money home per month. So yield is a nice and easy and lazy way to think about things, because the money into the deal, the money spent into the deal varies. So for example, you treat it like a cash machine. How much money did you put into this cash machine before it starts giving you the money back, your interest rate, or the cash out? And if you want free money, do you want free money? Do you want cash machines that give you free money? Property can do that. You can get houses for free, or the only way to think about these assets for free is to make sure you don't have any money left in the deal. If you have money in the deal, then it's not free. If you still have money in the deal, then make sure you have as little as possible for this asset that is making you money. So forget yield. So what is the better approach than yield? What should we consider? It's the return on investment. So why is this important? Because it's the annual net income. And instead of gross, it is net, which means that it actually considers the amount of costs involved throughout the year. So what is the actual money put into your bank account after costs? So think of it like this, because it's easy to calculate. How much money do we get back from your cash machine versus how much money you have left into the cash machine? So imagine this. Imagine you have £500 put into your bank, into your savings account, and then you get back from this 10%. Sorry, £10. £10 income on 12 months. So if you put into the formula, you get £10 out over £500 put into the deal, times 100, it's around about 2% return on investment. It's okay, not amazing, but it's fine. So here's a question. What percentage is your bank offering? Is it 2%? Is it 1%? Is it 0.5%? Is it 0.0000%? Most people are getting around about 0.1%. That's not even 1%, that's about 1/10 of a percent. Is your bank savings interest greater than inflation? Inflation at the time of recording is around about 3%, which means that if you're not getting 3%, then you're actually losing value, actually losing money in your savings account. Keeping money in your savings account is terrible because the fact is money is a currency. The pound or dollar is a currency. And what I mean by that is that with inflation, which means that the prices of things such as bread and milk go up over time, which means that you need more pounds, more dollars to buy the same thing. So the power of the currency goes down because currency is designed to go down. And what's your interest in your pension pot? This surprised me. And this one tricky fact I had to accept, and I hope to make you aware about it. I put X amount of money into my pension, and with time the company I used to work for also contributed to that pension. And one day I received a letter about how much pension I'd expect me to have in my pension savings pot when I retire at 68, and how much I would get back each and every year. I would get a whopping 3%. And I get that starting when I'm 68. The average lifespan of a guy is 81 years old, which means I have less than 13 years to enjoy my pension life, my pension pot. It isn't great. And that spurred me, it's one of the things that spurred me on to doing property investing and to secure your financial security for the future. Good thing about it is that you can have a higher percentage than what you're getting in the bank account. And you don't have to wait until you retire. You can do that. Now here's two examples using the same property. So here's a property found on Rightmove. It's a typical kind of property, and of course the price varies from location to location. So just use the principles here. So here's a property advertised on the market for £137,500. So typically as an investor, you stick down around about 25% deposits, and there's about £1,000 or £2,000 of fees. Let's just use that into our figures. So let's say, for example, this property, when you acquire it, it's about £550 of gross rent. Now you take off £230 for mortgage fees and letting fees, etc. It's around about leaving you in your pocket £220 into your bank account every single month. So over 12 months, it's around about £2,640. But remember, you did not put in £137,500 of your hard cash in. you only put in 25% of that. So 25% as deposit, plus a couple of £1,000 for fees and costs, etc., is around about £36,375 in. That's the money in. So if you think about the money out is 2640, the money in is 36,375, you are left with a return on investment of 7.2%. Not bad. Much better than the savings account. But let's assume it's the same deal, but the only difference is instead of 25%, it's 20% deposit, as on the deal on the right hand side. Now with less deposit, which means it's a slightly higher mortgage rate fee per month, so £550 rent, but now instead of £230, it's actually £250 mortgage and lettings fees, etc., leaving you in your pocket around about £200 per month. So 200 times 12 is 2,400. It's less money coming out per month. Sounds terrible. But the fact is, instead of 25% deposit, we only put in 20% deposit, 5% less, which means it's 27,500 into the deal, which means our return on investment is higher. We're getting more money for every pound we have spent into the deal. Does that make sense? I hope so. And this is a very important point to mention because as life of an investor, you go through the phase of acquisition where you buy, and you want to take as much money out quickly as possible to buy more properties. So having less money into the deal is a good thing. And then in the consolidation phase, you have to pay down debts. So that means is that you're paying back the lenders, you're paying back your investors, etc. And you go through that cycle. So your actions is to understand return on investment. So think of it as the money returned back to you compared to the money you invested into that cash machine in the first place. And think, what percentage are the banks offering to your family and your friends? Could you offer them more? Well, the answer should be yes. And what if you're earning 8%, maybe 10% plus of ROI? Could you give the investors, your friends, your family, or acquaintance, a portion of the profits each year if they give you all the money? How would you feel about that? If someone gave you £30,000 and you need to pay them back within 2 to 5 years, how would you feel? If someone gave you £1 million to spend on property, how would you feel? Scared? Worried? I hope not. It's just extra zeros. So I hope that helps. And do the actions, and we'll see you on the next web class.